Okay, let's dive right into this comprehensive explainer, where we get to play financial detective and uncover the true intrinsic value of the world's absolute largest carmaker, Toyota. Today, we're looking at a manufacturing titan that serves a massive chunk of global auto demand. But as any seasoned investor knows, a massive footprint doesn't automatically mean you're getting a massive bargain. Our goal right now is to cut straight through the noise, look past the flashy headlines, and figure out if Toyota's stock is actually worth your hard-earned money at its current valuation. So, here is our investment checklist for today. First, we'll break down the Toyota business engine. Second, we'll look at moats, rivals, and risks. Third, we're going to untangle the balance sheet illusion. Fourth, we'll get into calculating true intrinsic value. And finally, we'll deliver our final verdict. Let's jump right in. Starting off with Section 1, the Toyota business engine. You see, Toyota isn't just a car manufacturer earning a spread on mass market and luxury vehicles. It's actually a massive captive finance company, too. The revenue really splits into three main pillars. First, the obvious one, right? The spread between the price and the production cost of their massive vehicle lineup. We're talking staples like the Corolla, RAV4, Camry, and Hilux, all the way up to their luxury Lexus brand. Second, they generate this great recurring revenue through parts and service. But the third pillar is where it gets really interesting: interest and leasing through Toyota Financial Services. They don't just sell you a car, they literally fund the dealers and the buyers. This business model is incredibly durable and globally diversified, but keep in mind it's also highly capital-intensive and cyclical. Moving on to Section 2, moats, rivals, and risks. Here is a totally fascinating dynamic playing out right now. Toyota's genuine lead in hybrid technology is generating massive piles of real cash today, while a lot of their rivals are just burning money trying to catch up in the EV space. Their competitive moat is built on absolute scale, a legendary reputation for reliability that keeps resale values high, and the world-famous Toyota production system. On top of all that, management acts rationally. They execute steady share buybacks at low multiples, which shrinks the share count by about 1.5 to 2% every single year, and they maintain a fortress industrial balance sheet. Honestly, as the global EV transition has somewhat slowed and normalized, Toyota's strategy of just dominating the hybrid market looks incredibly prescient and highly profitable. However, we always have to weigh those strengths against some pretty serious structural threats. The most glaring weakness is their follower position in the pure EV and in-car software transition, where Chinese manufacturers, led by BYD, are competing fiercely on price and features. Plus, Toyota faces a potential permanent impairment from U.S. import tariffs imposed in 2025, which would structurally tax their export-heavy model. We also have to consider that their reported return on invested capital, or ROIC, is quite low, hovering around 4.2% recently. And finally, their recent earnings have been heavily flattered by a historically weak yen. If the yen sharply reverses, well, those translated earnings could really fall off a cliff. All right, Section 3, the balance sheet illusion. When you pull up Toyota's consolidated balance sheet, this alarming debt figure of $276 billion immediately jumps right off the page. Compared to their $87 billion in cash, it looks like a massive solvency red flag. For a typical industrial manufacturer, carrying this much debt usually signals an impending disaster. But here's the twist that completely demystifies the numbers. When you separate the bank from the car factory, you see a totally different picture. The industrial automotive side of Toyota is incredibly cash-rich, typically holding several trillion yen in net cash. It's arguably one of the strongest industrial balance sheets in the entire sector. So what about that massive $276 billion debt load? It simply funds their captive finance arm, Toyota Financial Services, and is perfectly matched by an equal book of finance receivables. It's not industrial leverage, it's literally just the capital needed to run a lending business. And this explains why you absolutely must look past the unusable consolidated cash flow numbers to realize Toyota is actually a highly cash-generative industrial powerhouse. When you look at standard financial screeners, Toyota's consolidated free cash flow often looks negative, or at least incredibly weak. But this is just an accounting illusion. The capital expenditure line includes vehicles leased out through the finance arm, and any growth in their finance receivables is counted as a cash outflow. If you strip away the finance book's growth, the core automotive business generates strong, consistently positive free cash flow. Wall Street screeners are essentially getting tricked by an accounting rule here. Which brings us to Section 4, calculating true intrinsic value. Let's weigh out our scenario valuations. We're heavily weighting a normalized owner earnings base here to account for both tariff headwinds and the notoriously cyclical nature of the auto industry. In our base scenario, we assume mid-cycle earnings where tariffs are absorbed and buybacks remain steady. That gives us normalized earnings of $17 per ADR, which is simply how international stocks trade on U.S. exchanges. We apply a 10 times multiple to that, arriving at an intrinsic value of about $170. Now, in a bear scenario, where tariffs structurally compress margins and EV market share is lost, earnings drop to $13. Applying an 8 times multiple there gives us roughly $104. Conversely, the bull scenario assumes under-earnings normalizes upward to $21, giving us a value of $231 at an 11 times multiple. Blending these models together and factoring in a pretty demanding 9% discount rate, which is the return we demand for taking on this risk, along with a conservative 2% long-term growth rate, gives us a base intrinsic fair value of roughly $175 per ADR. This is a highly realistic, clear-eyed view of what the company's future cash flows are actually worth to us today. But the reality of the situation is pretty stark. Sitting at roughly $176 today, there is absolutely zero margin of safety for new buyers. The stock is trading almost exactly at our calculated intrinsic value. If our estimates are even slightly too optimistic, or if the auto cycle turns sharply downward, a buyer at $176 has absolutely no downside protection. Let's put this into perspective. If you want your money to compound at a 9% hurdle rate annually over a 16-year horizon, you actually need to buy the stock at around $116. That assumes the fair value grows to about $300 over those 16 years. Even if you have a shorter 5-year horizon, you would still need an entry price of around $151 to hit that 9% annual return target. The current price of $176 simply doesn't offer the asymmetry that a disciplined value investor looks for. Honestly, it implies a total return closer to just 6 or 6.5% per year. Section 5, Final Verdict, Buy or Hold. Both Peter Lynch and Charlie Munger would likely look at this franchise and respect it as a reliable, fairly priced compounder, but it is certainly not a multi-bagger bargain poised to double or triple your money right now. Lynch would probably categorize this as a stalwart with cyclical features, something you buy for a moderate gain and a dependable dividend. Munger would likely call it a good business at a fair price, noting that fortress balance sheet, but also acknowledging its capital intensity and modest returns on capital. Bottom line, it's a highly resilient company, but it's facing a genuinely tough technological and trade landscape. Therefore, our definitive snapshot verdict is a hold. You want to keep an eye out for a target entry price much lower than today's valuation to guarantee a proper margin of safety. If you already own it, hey, the strong balance sheet and hybrid cash engine mean you can absolutely sleep well at night. But if you're looking to deploy new capital with a required 9% annual return, you really need to wait for a price somewhere between $116 and $150 per ADR. The current price is simply too perfect. It leaves no room for error. So the ultimate question remains, will Toyota's cash-printing hybrid strategy successfully bridge the gap to the future, or will the relentless EV transition and global tariffs eventually break down their fortress walls? Time will definitely tell. Since our investigation into Toyota is officially closed, I want to turn it over to you. Drop your requests in the comments and let me know which massive company we should run through the explainer next. Do you want us to look at another automotive giant like Honda, or maybe pivot to something entirely different in the software or healthcare space? The tools we use to break down a balance sheet and calculate intrinsic value apply across the board. Thank you so much for joining me for this explainer, and I will see you in the next one.